Hi. Welcome to Minneapolis Expression. My name is Brandon Ferdig. Tonight we're going to talk about money. I have with me a certified financial planner from right here in the Twin Cities. His name is Shannon, and I'm very happy to have him on the show.
I'm a certified financial planner, work for Web Financial Group. We're down in Bloomington. Work with private clients managing their portfolios.
Okay.
And especially doing a lot of counseling during these times.
Isn't this all pretty unprecedented? Or is this familiar territory?
It's familiar territory. Like you were saying, this is a regular occurrence in the markets. Every time it happens, it's scary. But it is a regular occurrence, and the fact that we're in another one means we got to the one previous.
That's true. That's true, and that's obviously the way you have to look at it. When you do this for your job. But of course, this is unique, though, is it not? Or is this comparable to previous recessions and financial circumstances that we've been through?
Every recession, bear market technically is a little bit different from itself. We had the oil embargo, et cetera. There's always different circumstances surrounding why we're in the state that we're in. And the reason being, hopefully we learn from this and don't repeat our mistakes.
What was talk about some of the mistakes.
Well, it's been said that this is all stemming from what they call easy money, which means interest rates historically were incredibly low, loans were easy to get, and that ended up manifesting itself into a lot of real estate transactions. Real estate was really on a big upswing, so those coinciding. Loans got pretty risky on real estate, and then when the market started to correct, created a domino effect.
I don't understand why a business would risk their stability so much as to lend out. I've been declined more than once for a credit card, and I'm offended and mad. But I understand why. It's because, you don't qualify for this high of a credit limit because you don't have the history, you don't have the statistics and the history backing you up, which on paper makes you a reliable, safe customer for us. So we're not going to let you have this credit card. Your history doesn't indicate that you would be a good customer for this credit limit, and I understand that. So I've been on the receiving end of rejection and stinginess, supposedly, and so I see banks that are being, conservative and not wanting to risk their money on someone who may not be, worth the risk. But in the case of overextending themselves with mortgages, why were banks so willing to lend out money to people who wouldn't be able to pay it back? Didn't the banks know that in 3 years, when these loans adjusted, that they were going to have a lot of people who weren't able to pay back these loans?
Well, there was some of a recent phenomenon. There was a new financial product called a collateralized debt obligation, and what that means is thousands of mortgages that were sold to the public were packaged together and sold on Wall Street as a security. So the banks didn't technically hold the loans on their books for too long. They held them long enough to package these securities together, and then they sold them to the investor.
So they were looking to just get all these securities bundled up from all these homeowner mortgages.
Correct.
And because they knew they could move them over to Wall Street.
Correct.
So why was Wall Street buying all these bad loans?
They're extremely complex products, these CDOs. They weren't well understood. And then there was another layer of risk that went on top of them with different derivatives that were being sold from them. AIGs in the news, they were insuring a lot of these types of securities. So all these different investment banks and such were kind of watching each other's back, so to say, covering each other's risk.
But someone got the shaft, and it was obviously, and I don't even know why it was, but it was Bear Stearns, and it was Lehman Brothers, or Lehman Brothers, I don't know, I hear it pronounced both ways. Why were these companies putting themselves in a bad place? Like I said, those guys wouldn't give me a credit card because they didn't want to risk me not paying my, my $50 a month, whatever payment. But they were willing to take on something that cost them all this money, all these billions of dollars. It seems so odd in hindsight why they put themselves in such a bad situation.
Lehman Brothers, Bear Stearns are a little bit different than the bank that would write your credit card. They're investment banks. They weren't holding companies, so they didn't actually take the deposits and run like a traditional deposit branch type bank would. So what actually happened with these investment banks was they were the ones creating these types of products, and like I said earlier, loans and money was so cheap and easy to get that they were highly leveraged themselves.
They were guaranteeing these loans or these securities, weren't they?
Not every types of securities. There were some that were guaranteed by them, called, for example, like a structured product would be guaranteed by them. But what happened was they were so highly leveraged that once, they needed overnight loans and things to help themselves, be servicing their own debt.
Yeah.
And once the credit started to tighten, they had a hard time holding themselves afloat.
Money is, if humanity, if the world and the humanity existing on the world is one organism, then the circulation of currency is the oxygen in the blood. I mean, if you stop, it's like stopping breathing. I mean, it's
as far as commerce goes, yes.
But specifically with those companies and why they went bankrupt, am I right in saying that? Well, maybe one, they were sort of secondary. They weren't really. Did they know that they were guaranteeing or they were dealing with loans that would eventually? Obviously, they didn't know they were going to eventually not get paid up, or get foreclosed on. It was going to be bad debt. Was it because they were the second or third, fourth person to touch that mortgage that maybe that far removal from the actual transaction between the banker and the homeowner, put them in a position that was so far off that they had no idea that these loans were being given out at risky situations?
That has a lot to do with how it kind of turned into a cancer and spread throughout the whole system. Because, like you're saying, these banks that would write the securities weren't the same banks that were granting the loans to the homeowner. So I'm sure a lot of the underwriting and certain risk measures got lost in the process.
So the banks would give out the money because they knew they could dump the debt somewhere else.
Correct.
But do you think the bankers and the mortgage brokers knew when they were writing these loans that these homeowners probably weren't going to be able to pay these things in 3 years? Or did they sort of just fool themselves into thinking, no, home prices are going to continue to go up at 10% a year?
It's hard to point the finger at anyone. There are a lot of people that have pointed the finger at what you're calling the predatory lenders. And they were out there. I would hesitate to throw all mortgage bankers and mortgage brokers in that pot. But it was in their interest to sell these mortgages, and not necessarily in their interest to make sure that they weren't risky outright.
I don't think any more than usual were malicious. I mean, of course, you always have people breaking the law and frauding and defrauding and illegally obtaining money, and of course, you always have people that do that. But apparently most of the honest brokers must have just been, because these were moral, ethical people. Do you think like me that they must have just assumed that Mr. and Mrs. Thompson would be fine with this loan after 3 years, that they'd be able to refinance and, get out of that 3-year arm or whatever, and everything would be okay?
Well, there was this, they call it the credit bubble. Like, there was the tech bubble, late in the late 90s, so about 10 years ago. And